So I'm going to talk to you today about the future of the blockchain and technologies like this in respect to the banking sector and how value exchange occurs. And so this sort of leads into both infrastructure and from a currency perspective. When we look at these technologies and we look historically at the influences on these technologies, maybe we look at the technologies in the banking sector that have affected the banking sector, and we can start with the mainframe computer. So this emerged in the 1950s. The first bank mainframe was built by MIT for Bank of America in the United States in 1953. They called it IRMA, Electronic Recording Machine for Accounting. And this was built essentially to handle check processing because humans could no longer process the amount of checks that were being distributed in the United States. So this was a big shift. Then in the 1980s, we start to look at self-servicing technologies, putting the bank outside of the building, enabling you now to do cash withdrawals and do basic banking outside of the bank branch. This extended in the mid-90s to the inclusion of internet banking. So you can now check your balance, check your statement, do some basic funds transfers and so forth online. And then along came in 2007 the smartphone with Steve Jobs with the iPhone. And this created an experience era where now we could do banking wherever we were. We didn't need to be tied to the physical bank or physical bank products anymore. We could tap our phone to pay for goods and services. We could do essentially everything we needed to do on a day-to-day basis through our mobile phone. As technologies like voice and artificial intelligence and within a decade, smart glasses, as these technologies emerge, more and more we're going to be integrating banking and new ways of dealing with currencies and value exchange into our life through this technology layer. But this can happen almost independently of the existing banking system from a technology point of view. So we look at the big innovations that have occurred throughout history, whether it's the steam machine or the telegraph or the telephone or the internet and now distributed ledger technologies. We see a pattern developing in terms of big disruptions that really change the world. And this comes through an engineering approach we call first principles design thinking. I'll illustrate this with a story about rockets, rocket design. I'm not sure if you're familiar with this, but this is the V2 rocket. This was used by the Germans near the end of the Second World War. But as it became clear that Germany was going to lose the Second World War, the Russians, the British and the Americans were rushing to capture the rocket scientists that worked on this technology because they knew they would be influential. The Americans had a list of 1,500 of these scientists, and at the top of the list was the name of this gentleman, Wernher von Braun. Now, Wernher von Braun surrendered to the Americans in Austria at the end of the Second World War and went on to be the father of the Apollo space program in the United States. In the late 60s and 1970s, this was the height of technology. Each launch cost about $1.2 billion in today's terms. It cost about $6,000 per kilogram to get a kilogram of material into orbit using the Apollo rocket. Over 50 years, we iterated on this design. We improved on it, improved on it, improved on it, till we'd got the cost down to half what it was in the Apollo days. But along came an entrepreneur by the name of Elon Musk. And using first principles design thinking, in just 14 years, with the pending launch of the Falcon Heavy rocket on December 29th, he's now able to get the cost of a kilogram to orbit down to about $300 US. Massive scale, massive benefits. But this occurred because Elon Musk asked a question. If we were going to build a rocket today, using all the technologies we have, would we build it the way Wernher von Braun built the V2 rocket or the Apollo rocket? And the answer was no. So we have to ask the same question in respect to currency and banking and value exchange. And when we look at these forces occurring in financial services, we realize first principles thinking is where the disruptive innovations occur. So this is SpaceX, but can you think of another example of first principles design thinking we've seen in the last 20 years or so? What about the iPhone, the Apple iPhone? Now, prior to the creation of the iPhone, you might have had a Nokia banana phone, or a Motorola flip phone, or a BlackBerry RIM keyboard. These were the phones that were very popular prior to the emergence of the iPhone. But the iPhone changed the game. It didn't iterate on those old models of those phones we used to have. It created something new. And everyone since has iterated on the iPhone design. So this was like a reset of the telephone, mobile telephone industry based on this new technology. But Steve Jobs and Johnny Ive, the creators of this device, they thought very differently. They said, how can we combine a web browser, an MP3 player, an app platform, and a phone into a multi-touch screen device that changes the way people interact on a day-to-day basis? Now, one of the first things that we realized when the iPhone came out was, hey, we could use this for banking. This could replace your credit card. You could just tap with your phone. And so this presented us with the opportunity to revolutionize money and the way we paid. And yet, when the iPhone came along, how did we deal with it? Instead of creating revolutionary new payment systems, what we did is we tried to put plastic inside the phone. Whether it's Samsung Pay or Apple Pay or these other technologies, we've essentially just linked it to the old banking system. This is not first principles design thinking. This is iterative thinking. But the threat of blockchain and DLT and these technologies is they are first principles approaches to the way we think about money and the way we think about transactions. The potential for disruption to the banking sector is very high. We can start to see the early examples of this. This is Yueibao, a Chinese mobile money market fund on top of the Ant Financial Alipay system. And they've already raised deposits of $185 billion. But this is not creating a savings product that you distribute through a bank branch. All of those deposits have been made through mobile technologies, not through a bank branch. They don't require you to fill out a form and sign with a signature on a piece of paper. This is first principles thinking we're starting to see emerge in the market. Or in the United States, where Uber has come. And I know recently, of course, we've had Kakao launch their bank here in Korea with great success based on internet technologies. But a better example probably is the way Uber handled banking. They had problems recruiting drivers in the United States. They couldn't grow fast enough. And they realized many of the drivers that were trying to sign up for Uber were stopping halfway during the sign-up process when it got to the requirement to put in a debit card. So Uber did some investigation, and they found that many of the taxi drivers that were working in New York and San Francisco and Chicago didn't have a bank account because they'd worked in the yellow taxi industry and only been paid in cash. But Uber couldn't pay them in cash. So Uber fixed this problem by enabling them to sign up for an Uber driver debit card when they signed up as a driver for Uber. They didn't want to be a bank, but by this innovation that they did, they became one of the largest acquirers of small business bank accounts in the United States, almost overnight. But this is a good example of banking embedded in the world through technology. You don't have to go to the bank anymore. The bank is just a part of your world based on this technology. So if you think about this shift overall, when we see things like WeChat in China or Alipay in China, we see these technologies emerging. This is not a payment product. It is not a plastic card. It doesn't require issuance through a bank branch. It doesn't require a signature, and yet it's been extremely successful as a payments technology. Not because it's a payment product issued from a bank, but because it creates the utility of payments. So I'll give you one other example of this utility change we're seeing in banking today. This is what we've built for Moven in the United States. Now we have about 250,000 customers in the US on our platform right now. We have close to 5 million globally through our distribution partnerships with TD Bank, BCA in Indonesia, and others around the world. But we launched this savings initiative in Q4 last year. And with Moven, what it does is it tells you whether you're being financially healthy or not. The app will turn green if you're below your average spending, or it will turn red if you're above. But when you're below, you might get a message on your smartphone, on the chatbot saying, hey, this is really good. You're spending below your typical spending. Or you might get a message on your smartwatch saying, you're $200 below your normal spending. What would you like to do with that money? How much would you like to save? $200, $100, or $50? And through this, 40% of our customers moved money from their spending account into the Moven Stash, what we call the Moven Savings capability. 40% of our customers. And yet we offer 0% APR, and we did no marketing to promote this savings experience. 40% conversion. No bank in the world could launch a savings product and have that sort of conversion using traditional marketing. But that's because we didn't create a savings product. We enabled savings behavior. So if you think about the utility of banking, what a bank provides you with today is the ability to pay, the ability to store value, and the ability to access credit. Really only 3 products. And yet we put all of these labels and product structures around it. We call it a credit card or a line of credit or an overdraft. But technology is stripping away those product structures and surfacing the pure utility of banking. This is evidence of first principles thinking. We're moving away from bank products and bank infrastructure to bank utility surfaced through technology layers. I'll show you one advertisement for the new Amazon Alexa, and I want you to make a note of the purchase that Alec Baldwin does just using his voice. Okay, let's play the video.
Yeah.
You're okay. He's okay. He made it.
Jason, what do you mean?
We were very bad boys.
Alexa, what's in the news?
Here's the news.
Alec Baldwin and Jason Schwartzman were seen mooning paparazzi. Baldwin grew a shoe at photographers before making a run for it.
My poor cashmere socks. Alexa, reorder another pair of Brescianis.
Reordering Bresciani socks.
Okay, listen. Can you send some lawyers or something? Alec.
So I'll just explain this a little bit for the translation. So the story goes, he had been out the night before. He'd had a big night with his friend. He had thrown a shoe at a photographer, and he now had a hole in his sock. So he asked his computer, Amazon Alexa, please reorder me some new socks. But did you see him take out the credit card? Did he need cash to do this? No, this technology, which is going to be very common over the next few years, whether you're using Samsung's Bixby, or Apple Siri, or Cortana, or Echo, Alexa, we'll be using voice to conduct commerce, but you won't need a plastic card. Conceivably, you could do that transaction in any currency, and the computer would just be able to work that out. So commerce is changing, not just with the introduction of voice technologies, but all of these devices in the future will be able to conduct commerce in an automated fashion because of technologies like the blockchain and combined with artificial intelligence. When commerce is conducted in this automated fashion, the current banking system cannot deal with this type of demand. We must have something like distributed ledger technology to enable this type of commerce. The existing banking system is not robust enough to be able to do this type of transactional activity. Now, underlying this is value exchange. How we provide value in commerce is through currency. But currency was designed always with a local mindset. It was designed to be used in the geography, primarily because 200 years ago, when currency's physical cash emerged, we didn't have large-scale foreign currency and commerce taking place. It was all localized. So the best form of value exchange was something that your local community recognized. And this is how we emerged with paper money, because people could have a common value exchange within that geography. But the value of a currency is only as good as the people who trust that currency. And we've seen in markets like, for example, in Venezuela and Zimbabwe, we've seen the erosion of trust in currencies can happen quite quickly. This is Venezuelan bolivars. These are worth about $15 in today's term. By the end of this discussion, it'll be worth less already because of deflation, or inflation rather, in that world. This is why Venezuelans now are adopting Bitcoin and US dollars for currencies and transactions rather than their existing currency. So the value can be stripped away. But here's the question. What difference is there between US dollars and Bitcoin in terms of the underlying value of that as a currency or as a crypto asset? Some would argue, well, one's backed by the US dollar, by the US government rather. But just like the Venezuelan government backing this currency, currency value exchange systems can be eroded when confidence disappears. There's really no difference in the ability of Bitcoin to act as a value exchange mechanism versus US dollar. If enough people have enough confidence in a cryptocurrency, then it could replace these physical currencies we see today. One example is the Pismo clam. During the Great Depression in the late 1920s and early 1930s, the US dollar lost confidence. People lost confidence in it as a local currency. In Pismo Beach in California, they came up with their own alternative currency that was more stable at the time than the US dollar, and it was clams, written on with Indian ink. These were worth about $1 each, but some of them worth 50 cents. And this is how people were trading in the local currency in this part of California at this time in the world. Now, you might think it's impossible for the US dollar or the euro to be eroded in respect to confidence in this currency system. But we've seen it happen before. It could happen again. So here's the real question. Based on global commerce that happens in real time, that could be enabled through artificial intelligence with voice and internet devices connected all around the world, conducting commerce themselves, trucks that deliver goods and services that have their own bank account, that get paid for their delivery, drones that deliver pizzas or groceries, agents that act on our behalf to conduct commerce for us just by us activating with our voice. There's no reason that these transactions in the future have to be underpinned with a geographically based currency. In fact, global commerce on the distributed ledger, on the Web 3.0 platform, in real time, tend towards a value exchange system that is much more robust in real time. A value exchange system where value can be appreciated based on the transactional utility. And this is where we see ICOs and other things taking us, towards utility-driven value exchange, not geographically based currency exchange. So let me ask you this question. If you were redesigning currency today to exist in this world and in the future over the next 50 or 100 years, would you design currency to be a paper note that's issued by a country? Or would you redesign currency to look more like the cryptocurrencies and crypto assets we have today? The answer is it wouldn't be paper-based because it has a low utility from a value exchange point of view. So this is really the way I think we have to think about this technology in terms of its impact. But thank you very much for your time this morning.